Hi everyone and welcome to the second episode of Sunrise&Grind. Today we're going to delve into the world of banking. Banking's seen a lot of innovation in the last decade with the emergence of mobile applications, digital onboarding, and neobanks disrupting the market. But if you look at the core of what a bank does, it's saving and lending. Has there been much innovation in that space? Today I'm joined by Ollie, his founder and CEO of Riff, to delve into this topic. Ollie, it's great to have you here.
Thanks for having me, Tom.
So I guess in the banking space, we've seen a lot of innovation, right? The core focus has been on innovating more the front end, the user experience. Digital banking has boomed. There are a number of kind of digital first banks that are entering the market, disrupting the kind of traditional high street banks. But do you feel there's a bit of a disconnect between innovation in banking in the front end and also, but more looking at innovation in the back end, like the products that they deliver, the products that they offer to clients at the end of the day?
Let's interrogate that question a bit, Tom, because you correctly called out some key points of innovation that's happened in banking through the year. So you said about Monzo and Starling correctly, like innovating the current account user experience. Revolut innovated in FX payments.
Yep.
We've had embedded finance, we've had buy now, pay later. But the key question is, what does a bank do? And have we really seen innovation? And then is that in the front end and the back end?
Yeah.
So what does a bank do?
Well, savings and loans, right?
Savings and loans is the number one thing that a bank does.
Exactly.
And also payments.
Yeah.
Right. We help her pay for
Yeah.
things. Payments has seen this astronomical boom in innovation. Loads of people in the space. Stable coins is now the latest craze. What has changed in savings and loans since, well, even I started my career, but in the last 5-10 years?
Yeah.
The products that I first had exactly the same. So innovation, I don't think, for the end customer has not changed in the savings and lending space. And that is partly down to there's a lack of it in the front end, and there's also a fundamental lack of change in the core as well. So I think you're essentially right, Tom.
And so why do you think there's been a lack of innovation, right? I mean, banks have innovation teams, they're large organizations. They're always looking at, what's going to be the next big thing? How do we increase our books, right? That's ultimately what the bank's objective is, right? They want to have more deposits at the end of the day, and they want to give out more loans, obviously considering the risk as well. But if this is such a big problem, why have they not innovated yet?
I actually really like there's another more experienced person here, that's Francesca Carlesi, UK Revolut CEO, and she cited several reasons, and the two that stuck out to me. One was she said it's hard. Right, let's not kid ourselves. Like, tearing up the very core of what a bank does is not easy. But the second reason, I think, and this may be a bit controversial in fact, is incentives.
Yeah.
Right, like an incentive to change. In these big high street banks, why? Who has an incentive to change? Because you're paid relatively well.
Yeah.
You might not get the recognition for the change being implemented. And even if you do, you don't necessarily feel the benefit. Your organization does.
Yeah.
So what is the incentive for change? And that, I think, is what she alluded to as being a massive factor. And potentially, I would also say, is a reason that you haven't seen as much change in that space.
Yeah. Oh, excellent. And how do you create that incentive then, right? Why, if this is something that clients will definitely benefit from, why have banks not done that? And what kind of incentives can there be? Is it more of a education lesson for the banks to see that they're missing out a big part of the market where they could capture more deposits, give out more loans, earn more interest on those loans? Or is it more culturally something has to change?
I think it can be two things, right? Like, so culture is, I think, how you change something. So Revolut, for example, I pick up, and I'm a bit hard of podcast talking about Revolut, but they do have a huge culture of change and innovation and moving at pace. So that is a way of how you change. What's going to be the catalyst for that change is an interesting question. So for me, the catalyst can probably come from a few areas. Number one, customers. So customers, 80% of customers now are going online. That is a change that instilled banks to improve their phone applications.
Yep.
2, technology is fundamentally changing. Do you really think in the world of like AI, we're going to be going onto banking websites, scrolling down product lists and clicking like select?
Yeah.
It's not going to be like that. It's going to be a conversation between your
100%.
AI agent
Yeah.
and the bank's AI agent.
Yeah.
And finally, I think I haven't said this, competition. So if there's one bank that changes, the rest instantly have to follow.
Absolutely.
There's a phrase that someone recently told me where every bank wants to be third.
Yeah.
Which is a bit, which is a bit harsh to them. But they never want to be, they struggle to be the front runner, but as soon as someone's made the jump, they are racing to catch
Absolutely.
up.
You don't want to be the first one, right? You want to learn from the mistakes. And then you also don't want to be second because you want to see that there's more momentum behind it. That's why you want to be the third. No, definitely. And I think, what you're alluding to is something which happened a lot in the kind of savings investment space, right? In the pension space, there's been a lot of hyper personalization of products in that space. And the pensions freedoms have allowed people to start investing themselves, DIY investments. So people have more options. And I think maybe that's a trend in finance. People want more control of their money and how they use it. Right. And I think, you said something perfectly well. Banks haven't really offered that. Right. We still go for the same mortgage, 2-year, 3-year fixed rates. When we take out a personal loan, it's only ever 60 months at this rate. There is no hyper personalization really. And perhaps that's something which, a lot of the banks will take away from this podcast is seeing that a lot of industries are moving forward, focusing on what is it that the user wants and how are they going to adapt and evolve as well.
You can come do the sales pitches for me. That's exactly right.
No, excellent. So Ollie, a big part of this podcast, before we dive into all the fun and interesting things you're doing at Riff, is to understand your story a bit more and talk about your journey from the banking world and moving into entrepreneurship and starting Riff as a company. So I wanted to understand a bit more. You're very successful in your career, working in the banking industry, a very senior individual as well within the bank. What was it that made you kind of decide to move from, banking, stable environment, very stable job to, the depths of entrepreneurship? Everything's uncertain. You have, you got to come up with a plan. No one else is around really to help you. You don't have the team behind you. Tell us about that story and what made you move.
I'm instantly feeling like I've made a bad decision the way you set that up, Tom. Look, for me, I think it's first and foremost to say that I love my job. Right? There was nothing that I didn't enjoy about the job that I left. So for context, for people listening, I headed up the treasury investment portfolio team. It was 150 billion worth of assets. Had a fantastic team, fantastic bosses. I enjoyed going into work every day. But I think in every decision, there's like a push and a pull factor. And the push factor for me when I was leaving NatWest was just my development curve was massively flattening out. And I just felt myself creeping and searching for a new challenge. So I went into CBDCs and stable coins and blockchain and, and I just needed something new. And that was the push. I was reaching my development curve limit for where that organization was for me. The pull is it's a bit cheesy, Tom, but you only have one life, right? And I just didn't want to look back on my 80 years of enjoying this planet and not have given this a go. And I think there's one extra point here. There's a massive amount of privilege in that position. This is not an easy jump that's for everyone to make. But it's one that I was lucky enough to have the opportunity to do. And I've definitely learnt, developed. Whether I feel like it's a successful journey so far is still to be determined. But I think even if touch wood, this goes well, but if it didn't go well, I would have learned and developed way more than I would have having sat in my old seat.
100%. No, I completely agree. There's certain things you can't really pay for. The experience of doing what you're doing now is something you can apply throughout any career. And it's amazing to see you do that jump and take that leap. I mean, looking back now, so you've been in leading Riff for the last year,
Almost
full
a year.
time.
I'd
Yeah,
say
almost a
it's
year full
almost
time.
9 months now.
What was the biggest shock factor of making that jump? Right, what was the hardest thing for you to swallow? Like, everyone calculates the risk. I'm sure you thought about it. This is what we're gonna do. This is the plan. But what was the real curveball so far in the time that you've been leading Riff and building the company?
I think the instant shock factor is everyone doesn't think you're fantastic. the moment you leave the door.
Yep.
I laugh really, but like you come from a place where you have a lot of power and decision making and a lot of people supporting you to a place where you're completely by yourself and you're trying to convince them that your way is the right way and what they've been doing for the last 10 years is wrong. And I naively, I think at the time, thought that everyone would be so blown away with my logical, economic, rational arguments that they would come running towards Riff. But actually, it takes time. It takes time of shouting into the void for people to start to listen, for the first early adopter, and then the early adopter leads the way after that.
100%. I think it's. I think you touched on a really interesting point. Is that when you make that move from, say, a very successful corporate career, you have all of this experience behind you, and also a lot of trust in a lot of your peers. But when you leave to start your own company, that almost gets resets to zero, because it doesn't matter where you've come from, doesn't matter the experience you have or the relationships that you've had before. You're trying to build something new, and new is always unknown. And I think ultimately that is what is scary for a lot of potential clients. They just don't know who you are yet. You could talk, I did this before, I was at NatWest or I was in the banking industry. That's great, but this company is only 9, 10, 12 months old. We need to see some proof in the pudding first. And I think that absolutely you hit the nail on the head. It's a very humbling experience when you kind of go into a meeting and you think, right, this is how it's going to go, and it does not go that way.
No. You've definitely. I think the number one thing, and it's probably very common on entrepreneurial feedback, but it's resilience is one of those factors that you constantly get knocked back.
Gotta have a Teflon coat.
And it always feels like little challenge here and little challenge there. But I mean, to be honest, I could go back. You could go back, get a corporate job if we weren't ready to take that challenge. It is the knocks that make it a more exciting, longer term
100%.
journey.
No, I agree definitely. And to touch more on Riff and the banking side. So you left to set up a tech business which automates a certain amount of processes within the banking industry. How come you didn't feel that you could have done it in the bank? Right? There must have been like large innovation teams. There must have been large tech teams. Potentially had some budget. How come you didn't feel that that's something you could have pushed internally?
It's a fantastic question. I guess for me, the risk reward payoff wasn't right. The risk being changing something inside a bank is incredibly slow and painful. Now, just to put that in context, if I wanted to change something within the bank today, I'd have to apply for budget this year that would then get given to me next year.
All right.
And there's a 25-50% probability that my project is going to be deemed worthwhile. And then between now and the day it's actually given to me, there could be a serious probability that's taken away due to XYZ shock.
Definitely.
Now, when you get budget, you then get the next problem, which is project teams in a bank, and apologies to be critical here, are incredibly slow. And I didn't really appreciate how slow it was until we started doing our own software where we could knock something together. And I think it's a relatively small team within a month. But within a bank, it would have taken me a year before I would even seen the first bit of software that I was able to use. So the risk of it just taking too long was too great. And I can't disagree with the reward side. If I managed to change something internally for a bank, my reward would have been, a thankful, extra couple of K on the bonus. But a reward for setting up your own company and changing the industry really felt like you wanted your own equity to make that worthwhile.
Absolutely. And that's real impact though as well, right?
Yes.
You're not just changing it for one bank. You could potentially be changing the whole industry and how they operate.
And that goes back to our original point, which is why did you want to do this? One of the key factors for me is enjoy the earth, enjoy the time you're on the earth. How do I get enjoyment? Well, big factor for me for enjoyment is doing difficult things and changing things for the better.
Yeah.
Because why else are we here? It's not to do that.
Exactly. Yeah, no, definitely. So let's go into a bit more detail. How does Riff work?
How does Riff work?
Yep.
Well, we enable banks to produce thousands upon thousands of different product variations. So currently a bank today, you'll be surprised, produces about 100 products, which you'll see in different various forms. But in order to make it feel like a tailorable product for you, they need to explode that product list to tens of thousands of different little variations that Tom might want. And in order to do that, they cannot use the processes that they're running today. It takes them roughly 6 days to get from concept to new price on the market for 100 products. Wow. What I'm talking about is making their product list tens of thousands and doing it instantly.
Wow.
And therefore, we need a new software.
And not to be devil's advocate, you know the banking industry, and so do I. We've both worked in that space. Doesn't this create a lot more overhead for the bank? Is it more Is it going to be more tiresome to keep track of these products? How is it going to fit into the wider kind of banking ecosystem? Because I guess as a CEO of a bank, if I was a CEO of a bank, if there's no problem at the moment, right? Why do I need to change? I think that's the question that I want to ask you.
Well, let me break those two problems that question down into two. Right, one was why should I change?
Yeah.
And the first question was,
Overheads.
is it making my world
more complex,
more painful
when it's already complex enough?
Yeah.
Yes.
And I would argue it's already complex because it's taking you 6 days to do it. So we'll take that 6 days and we'll take it down into instantaneous processing. And that's our first step to what we call our target solution. Yeah. We don't change your products on day one.
Sure.
We don't talk about this massive customization journey on day one. What we do is take your 6-day process and make it instant.
Wow.
And then what we do is we take an incremental, like, new product.
Yeah.
Like, we take that 100 products, we turn it to 150. We take it 200. It becomes incrementally easier to add the products because you've automated everything. Yeah. So I fundamentally believe that we can make the world much more streamlined and less cost effective for you.
Maybe.
If that's not a good enough selling point for your second answer, I've got a couple of second points on the second one. So why should you change? Yeah. And for me, it's all about shareholder value for you as a bank. Like, if you're looking at, let's take Starling's results today. Starling came out with their results today. They fundamentally failed on their financial results by missing on their lending target and slightly on their deposit base as well. If you don't innovate, the volume of that business will go to another bank. If you don't innovate, you're going to lose margin. If you don't innovate, you're going to lose shareholder value because of lower return on capital. Yeah. So I hit you and I improve the metrics that you care about the most for your business. And that's why you should care about innovating in, honestly, your most important product. Like, we're talking about this is what
the foundations of banks. Yeah, absolutely.
Like, this is an 800 billion balance sheet for a large bank. You've got to be focusing on innovating in this space.
Yeah, for sure. No, that makes a lot of sense. So let's have a look at it from the customer's perspective. Yeah. What would the customer see if a bank were to integrate Riff? How would that benefit me as a consumer?
Interesting. Okay, let's do an example. Let's imagine you found the love of your life and you're getting married in 9 months' time and you want to save for that upcoming wedding. And you went to any of the large high street banks today, what options would you have? Everyday saver, right? That's instant access, incredibly low savings rate.
Exactly.
They normally offer a 1-year bond, which is too long, about 9 months.
Out the timeline.
And a 2-year bond, again, outside your timeline. So you're left with this instant access, low savings rate option, which is financially penalising you. Yeah. What you should be able to do in the old branch manager world is, I want to save for 8-month period. Here's my $3,000 branch manager. Yeah. What's the rate on that today? And that's a slightly simplified model of what we want to get back to in a digital space.
So Yeah, it's really good. That's a really interesting point. So you talked about in the old days you could do that.
Yeah.
Where do you think it got lost? Because yeah, as you said, you're right, and I completely forgot about this as well. You could just used to walk into your branch and say, "I want to save for this amount of time. What's
Yeah.
the rate going to be?"
Yeah.
And so, yeah, where did that get lost? Do you think?
I have a very strong theory about this, which is in the 1990s, there were two changes that happened in the world. Change one was they started centralizing pricing teams, like the branch manager. They fired them all, and they moved one branch manager into these head offices, and that branch manager now responsible for pricing to all of these different branches. The second thing that happened in the 90s, which we kind of take for granted now, is this growth in like fixed rate products that we all use. Those two scenarios created two problems, really. Problem one is, how do we cater for what all customers like yourself, Tom, could want, when what they could want is basically infinite? Like, how long do you want to borrow and save for? How much do you want to, what do you borrow and save for? So they did a very sensible thing at the time, which they constrained it to like the most popular choices. And then how do you keep updating those products? And back in the day, they used to literally physically put up posters with the rate on them. When interest rates change every second of every day, well, they didn't change the rate. They just put a fixed rate offer up for like a month at that time. So that problem of these physical branches with one branch manager created this environment we live in today of stale product prices with limited choice. And that is not a world, in my view, we need to live in for the foreseeable future.
How is kind of the early adoption coming along? How are your initial conversations with some of these banks coming along?
It's very interesting. So there is universal agreement that this vision of what we're talking about, personalization and real time, is the future. I haven't had any pushback on the fact that that is the direction of the market. And in fact, you're incrementally seeing like smaller and smaller steps to get there. The pushback, the challenge that we get at Riff is, how do I go from where I am today to where I need to be in the future, like this personalization future? And we take them through this 3-stage, process, which is one, don't change your product. We're just going to automate all of the internal processes that you're doing today. That doesn't sound too scary. We make everything more efficient for you. Stage 2 is we do that, and then we can distribute it to customers in real time. So we spoke about a 6-day process earlier. We now take it down to an instant time frame. And then stage 3 is we start to incrementally add products. So we add a little 9-month savings rate for you, Tom. We add a 6-month, we don't group it into those months. We say any day. And that is essentially the future for both your savings side and your lending side as well.
So Ollie, as founder and CEO of Riff, tell us a bit about Riff. What are you guys doing differently in this space? How are you tackling the problem that we discussed at the start of this podcast?
Yeah, thanks, Tom. So we enable hyper-personalized banking retail products. So for you, as a customer, you get a product that's exactly tailored to what you need, rather than choosing for a product that a bank essentially designed that might not fit your needs.
Why should I partner with Riff, integrate Riff into my business process? I mean, from what it sounds like, it seems like maybe it's more headache for me as a business owner. Would it be more headache for my teams? So yeah, explain to me why I should integrate something like Riff when in this market it doesn't seem like there's a problem for me as a bank.
I think I have one core factor, which is probably the thing I think a CEO cares about the most. We deliver shareholder value. Shareholder value from higher volume, wider margins, better return on capital, lower cost. We even improve something called consumer duty, which I won't bore you with, Tom, but it's a piece of regulation that is top of the mind for a lot of retail investors. So delivering shareholder value through better products for your customers is fundamental to what we do.
And in terms of if we did integrate something like Riff, does that create more operational overheads?
No, if anything, currently what we do when we discuss with customers, we take a 6-day process, then we convert it down to essentially seconds. So that operational process is, if anything, improved. Now, with any project, there's going to be short-term pain
Yeah.
for long-term gain. But this is definitely a case of this is your largest product. If you're not innovating here, then you're really going to fall behind the pack.
Yeah. Let's take it to the consumer side. Right? As myself, as a consumer of a bank, I bank with Barclays, for example. What does Riff look like for me? And like, how would that benefit me in any way?
Well, let's talk about an example, if that's right, Tom. So let's say you're getting married in 9 months' time and you went to a high street bank today. What choices would you have?
Everyday saver, 1 year bond, 2 year bonds, cash ISAs, but can't access them that well. Yeah.
So you're spot on. In that 3 products, you only essentially have one choice, which is an instant access, either ISA or non-ISA. And that comes with a very low interest rate.
Yeah.
An interest rate you didn't deserve as a customer for a 9 month saver. You should have got a higher rate for that 9 month period. And essentially that is a classic example of a lack of choice being provided to you as a customer, then you're being financially penalized for. Right. And if you don't get that opportunity and a bank doesn't provide it, you will move eventually to someone who does.
Definitely.
And that is why the consumer cares, and that is why a bank should care.
No, 100%. I think you hit the nail on the head. A lot of, I'd say, consumers now have multiple bank accounts because rates are vary depending bank on bank, and also the products. But then ultimately, actually, the products are also all very similar. So what you're saying essentially is with Riff, if I wanted to save for a specific certain amount of time, I could get a personalized interest rate for that time.
Exactly. Personalized not only in term,
Yeah.
but when you took the product as well. Imagine like you were sitting there when Liz Truss was blowing up the economy. Banks, you went on banks' savings websites. Yeah. You wouldn't have seen that opportunity at all. We need to get to this hyper-personalized, hyper-product that best suits your needs.
Yeah, you're absolutely right. You know, the end consumers didn't benefit from the highest interest rate rises that we saw in the last couple of years. You know, whilst the bank rates did go up, they didn't go up in line with, like I'd say, Bank of England rates. Not well. It wasn't passed down to the consumer.
Yeah. So
what you're trying to do is overcome that and build that hyper personalized service for consumers.
100%, and it's kind of interesting on both sides of a bank's offering. Right, so lending sides, a bank is much more, main high street banks can be much more rate sensitive on the lending side and not giving you the benefit on the liability side. Some of the startup institutions are much closer to what I'm talking about on the savings side. We just do not see this universal move towards hyper-personalization that is essentially the future.
And so how are early conversations going, early adoptions, partnerships? You know, I've seen you in the market. You know, you've been speaking to a number of the largest banks at the moment. How are things going?
They've been fantastic, honestly. Like the one thing you realize when you go out into this world is your network opens so many doors for you. And people have been very friendly, very welcoming to the concept. In fact, there's been almost universal agreement that this concept of hyper-personalization is where the market is going. And we've been very lucky in the first 9 months to have, I guess, partnered with a tier 1 bank to trial our pricing tool. We have another tier 1 bank closing in on the final functional study at the moment.
Amazing. And
we have a nice partnership with a kind of a startup neobank that's in the pipes as well.
Yeah.
So good early traction.
Yeah.
I hope for more from the up and comers as we go.
And if there are a few banks watching this podcast at the moment, how does one get started with Riff? Right? Like it's a large problem which banks will have to overcome, and it's not a simple project. I think we both agree on that. But how does Riff make it simpler?
We generally take into a 3-stage process. So we talk about, firstly, just step 1 of getting this hyper-personalization phase is get your existing product set automated and optimized. And the way that we start off by doing that is just start off with a 2-day functional study. At the end of that 2-day functional study, you come away with a booklet on exactly how we're going to implement that stage 1, which is don't change your products, just speed up the time and optimization of the rate that it's being offered. And that is an easy first step to starting this longer term vision that we're going for.
Perfect. Well, you heard it here. If you're a bank and listening in, then reach out to Ollie here at Riff and he can start that journey for you.
Thanks, Tom.
Yeah, excellent. So Ollie, founder and CEO of Riff, tell us a bit about what does Riff do? What is the problem that it's trying to solve? And why is there a problem in the market?
Great questions.
Yeah.
The problem that Riff is trying to solve is there's a lack of choice in banking products today. And we believe a hyper-personalized product for Tom, for example, is the way a banking product should be, rather than you having to choose from a product that's been designed by a bank.
Right. And so say if I'm the CEO of a bank, give me an idea of why I need to integrate with Riff. Why do I need to partner with Riff? Is it going to cause more overheads for me because it sounds hyper-personalization of products means more products? Is that going to be more of an operational burden on my teams? And ultimately, what is the core benefit?
Yeah, okay. Let's break that down into the two different components. Component one is, what is the operational pain you're going to go through? And I would say materially less once you have Riff implemented. The reason being is it takes 6 days for you to produce a price on your current product set. We can make that into seconds. And in the future, we can add more and more products to that with no detrimental impact on performance. Now, why should you go through the pain of implementing, even if the operational benefit hasn't convinced you yet? Well, I deliver the thing that you care about as a bank CEO the most, which is shareholder value. And shareholder value from Riff comes from better products that deliver 4 things: more volume, more margin, lower cost, higher return on capital. And that is, for a bank CEO, should be gold.
Definitely. And flip it the other way, as a consumer, right? What does Riff look like for me? And how would Riff benefit myself if my bank integrated with them?
Yeah. So imagine, let's take an example, Tom. Imagine you're getting married in 9 months' time. What high street choices from a large high street bank would you have to help you save for that 9-month period?
Well, you've got the everyday saver, kind of instant access, 1-year bonds, 2-year bonds, but I guess that kind of is beyond my timeline of the 9 months. So yeah, I guess there isn't much.
Spot on. You could only choose the instant access in that scenario, and that has a very, very low rate. So this is an example for you as a consumer. You're being constrained. You have a lack of choice, and it's hurting you financially. And for a bank, well, if they don't offer that eventually, and another large street banker does, then eventually they'll lose that volume.
Yeah, absolutely. I mean, you would just move your deposits, right? You will want to go with the bank, which gives you that flexibility. So what Riff is trying to solve is the challenge of not really having that many products on the market that fit my personal needs as a consumer.
Exactly.
We feel like we've been bucketed into either everyday saver, 1 year, 2 year. But in real life, people want to save for different things. Could be buying a car, could be for getting married. And those timelines are not exactly 1 year or 2 year or 5 year, for example.
The biggest travesty in my example, so some people who are banking experts will be screaming down the lens at me at the moment going, you could offer customers whatever you want on the savings side, they're not going to move. And there's this idea of sticky deposits in large banks. But the biggest travesty that if you're a sticky bank, I think you do on a mortgage side, is you do exactly what you said, Tom. You group customers together into these, apologies for the jargon, but loan to value buckets.
Yeah.
So a low risk borrower, let's say you're borrowing £65 for every £100 house you want to buy, gets exactly the same rate as a 75% borrower.
Yeah.
And that is mad.
Yeah.
Right? That is mad.
Yeah.
Like from a consumer perspective, you're being treated exactly the same. And there is a small nerdy banking point that I could go into of why that is not good as well. But that's just another example where these group products are insufficient for the modern digital age.
And I think we talked about it before, a while back, you could go into a bank and say, and this was when high street banks were operating and you could walk in and talk to the branch manager. You could bring in £3,000 and say, I want to save for 6 months. What's the rate?
Yeah.
Like where did that disappear?
It was the 1990s, Tom.
Yeah.
Is our thesis. They took that friendly branch manager that you had and they put him in head office. And that created essentially two problems. Problem one is if you have one head office and multiple physical branches, how do you distribute all of the different things that a customer could want? And you can't.
Yeah.
So you have to constrain choice. And that's why I grew up in a world where it seems perfectly normal now that there's only 2 mortgage products and 3 savings products.
Yeah.
And that is not the case in the future.
No.
The vision I think of the future is a friendly digital branch manager.
Absolutely. And it's almost come full circle. I assume back then the reason why that kind of got centralized was because of the overheads, the cost of giving out personalized products. But now with technology, the advancements that have been made and what Riff are trying to do, that overhead is getting removed. And now we're kind of going back towards that personalization. And you know, you can look at that across multiple industries. In the insurance space or in the pension space, there is hyper-personalization now. But you're right, in the banking space, it has been pretty stagnant for a long time.
It's been incredibly resistant to change, which is bizarre because their other massive banking sector, which is payments, has been so innovative and so dynamic. Now, one of the theories I have behind this is it's a little bit harder to get into the banking and savings and lending space, but there's a big beast coming, right?
Yep.
And that beast is Revolut, who are launching banking and savings products in Europe and eventually in the UK. And if they're not going to innovate, I'm 100% certain some of the other neobanks are. And then all of a sudden, your high street banks should be as well.
Yeah, definitely. I mean, if that's not a big enough warning sign for the high street banks and the larger players to start moving, then I don't know what is.
Yeah.
Well, on the point of moving and change, how are your early conversations coming along? How are your partnerships coming along, your trials? What is the feedback you're getting at the moment in the industry?
The feedback's been honestly fantastic. Everyone has universal agreement that this vision of like hyper personalization, much more real time, is the future, and they're starting to see more and more examples of this happening. We've had excellent traction with a few key players. So we've done this automated pricing pilot with a UK tier 1 bank.
Excellent.
We have another one coming along the way, probably in Q3 this year, and then another one with a neobank later this year as well. So traction has started strong and hopefully builds for the rest of the year.
I'm sure it will. I think it's a very topical conversation at the moment, especially with how interest rates have been fluctuating a lot in the last, I'd say, 2 to 3 years.
Yeah.
You know, coming out of COVID as well. So if I was a listener and I'm within a CEO of a bank who's listening in on this podcast, how does one get started? Right, because let's not lie. It's a big problem to address. There's gonna be some pain, right? When any time it comes to changing operational processes, especially within tier 1 banks, it's gonna be hard.
Yeah.
But how can I start with Riff?
Well, you need to de-risk that concern that you had as much as humanly possible. So Riff, what we do with Riff is we do a 2-day functional study with you and your team. So at the end of that 2-day functional study, you have a piece of output that outlines exactly the cost-benefit analysis, the technology change, and the benefit of going through that technology change. And the overall outcome is you're de-risked from that go, no-go decision. And you essentially have a clear path of how you get from here today to at least the first step of what we're talking about with Riff.
Perfect. And talking about collaborating with Riff, looking at fintechs and the boom in fintechs over the last decade. You've seen a lot of large banks and investment banks as well acquire these fintechs and bring them in-house. Do you see a world where fintechs and banks are on a collision course? How are they going to work in the modern world with banking? Are they going to remain separate? Are they going to try and acquire and integrate and keep the IPs? What do you see this space evolving into?
Interesting. Very interesting question. So I think let's split the fintech world up into 2 distinct bubbles to start off with. One, a B2B fintech, and a secondly, let's talk about B2C. So, and B2B is 100% like Riff is, reliant on partnerships and working with banks and growing together. So I don't see that as a collision course, Tom. I see that bringing out the best hopefully in both worlds. So banks have the customer base and the resource, the technology. Fintechs have the ideas, the working at speed, the enthusiasm for change. And those two go off and make something fantastic in the future. B2Cs, are they on a collision course? I have a slightly controversial view here, which I think the answer is basically no. And the reason being is they're operating on two completely different scales. Right? Everyone is, Monza, Starling, to a certain degree, Revolut. They attract an enormous amount of news and attention, but they really are, from a size of business perspective, relatively, this is a harsh word to use, but irrelevant compared to the large institutions. So balance sheet size alone, we're talking, Starling around 10. HSBC has 1.5 trillion. Sorry, HSBC has even more. But Lloyds has 900. They're all around the trillion mark. Starling's results came out yesterday. They printed 200 million, net profit. The old desk I used to run within NatWest, we were roughly, let's say, 25, 50% my desk alone within NatWest. So the scale is just enormous. So for me, in order, if they're on a collision course, there's got to be more competition between the two. And in order to be more competition, if you're going to make that argument, you have to be sure that these neobanks and startups are going to close the gap between the two. And I'm maybe more skeptical that they can do that without real innovation. That hopefully the likes of Riff can assist with. But we need more confidence that they have the ability to close the gap.
100%. For now, I think I see it. They are in a world where they can coexist.
Exactly.
They're not. I agree with what you're saying.
And I think if you took the example, even of the current account example, where these startups, fintechs, built these amazing, great UX experiences for customers. What happened? Big banks just copied it.
Exactly.
3 years later.
Takes time, but they do move.
They do move. They do move when they see their business being threatened.
100%. And maybe now is the time for them to move in this space as well.
I hope so, Tom.
So look, we've worked together in the past. What is it that really kind of, as a startup business, as you look to scale, how do you see your relationship with technology partners, and how important is it, and what kind of partners do you want to work with? Because I think a big question in this space is, do you work with a team externally, a third party, and build a true partnership with them to scale your product, or do you build and hire internally? And I think that is the biggest question a lot of founders end up asking themselves. So I'd love to get your perspective.
Well, I think there's always, let's call it the big three things of what you're looking for with a technology partner. The first and foremost that stands out above all the rest is competence. You cannot, we're a software as a service provider. Our technology stack is our product. So they need to be competent enough to deliver that in partnership with you. The second thing that you've got to have is, I think, cost, to be frank. So you're working on a very tight budget as a startup, and cost is a key element of that. Now, those two often, are seen as a trade-off, but honestly, my experience is they're not always seen as a trade-off. You can have good partners who deliver competently and at a good cost price. And the final thing is collaboration, right? A flexibility and an ability almost to bet and believe in you, which I think is where our relationship really started off. Is you were an early supporter of what we were trying to do, and that collaboration I've also noticed has a certain amount of flexibility to it. So we need to scale up sometimes and scale down very quickly, and having that doesn't happen with an in-house team. So I think there's a world which both work well, but for me this has been an excellent model.
We touched on the wider ecosystem earlier. I'd love to get your thoughts on where you see the wider banking ecosystem in the next 12, 24 months. And also potentially, what part does Riff play in that?
Yeah, I mean, it's a hugely exciting space, right? So the next 12 months, I'm highly, highly confident, because we're working with some players, that a bank will be able to instantly reprice every product that it offers to customers within a second. And that is a fundamental change from where we are today. The next big change is you as the end consumer will start to see an ability for them to update prices more frequently. So hopefully we never see that situation again of stale rates during Liz Truss or exciting periods of time. And then the final era of what we're talking about, maybe in 2027, is customizable products for you, Dom. So you get to build your first customized product. So maybe it's a more granular loan to value borrowing mortgage. Maybe it's a more granular savings rate. Wherever our customers want to take and offer that USP to their customers is where we see in 2027.
That brings us to the end of the podcast today. Thank you, Ollie. I think we delved into a number of different topics that are really interesting. I think some of the core takeaways will be that this is a problem that the markets are facing, and this is a risk area for banks if they are not going to innovate in this space. And thirdly, there is a demand from consumers to have more hyper-personalized banking products, whether it's on the saving side or the lending side. Thank you everyone for tuning in to this episode of Sunrise and Grind. If anything resonated with you in this podcast, please give it a like, subscribe, and tune in for future episodes.